Your home loans are set to get more expensive, but your deposits in banks will fetch you more money. Inflation could be easing, but economic growth will also slow. How does the RBI's decision today affect your pocket and the economy? The RBI's Monetary Policy Committee today hiked the repo rate by 35 basis points to 6.25%. The last time the repo rate was this high was on 7th February 2019, which means that we've far exceeded the pre-pandemic levels in terms of interest rates. The good news here is that this 35 basis points hike is lower than the 50 basis point hikes done in May, June and August of this year. What this implies is that inflationary pressures seem to be easing. That is, the worst of the high inflation days could be behind us. However, the RBI Governor Shaktikanta Das has also said that the RBI would continue to keep a sharp eye on inflation, which would not go below 4% for at least the next 12 months. So while the worst is behind us, don't expect low inflation for some time to come. The RBI's decision to hike rates once again is in keeping with what central banks around the world are doing. The US Fed has also hiked its policy rate by about 75 basis points to 3.75 to 4%, although it has hinted that the size of the hike next time around might be smaller. The Bank of England too has hiked its interest rates by 75 basis points and hinted at increasing rates further to bring down inflation down to their target level. The Reserve Bank of Australia, Norway's Norges Bank, Sweden's Riksbank and the Reserve Bank of New Zealand all have raised interest rates in November and are expected to raise them again this month or in early January. Now, the question is, do the RBI's rates actually have an impact on inflation? The answer is yes, but eventually. The problem lies in transmission. Transmission refers to the RBI's decision being transferred to the public. The middlemen in this process are the banks. Once the RBI hikes the rates, the banks also have to hike their rates so that the public can be affected. This process used to take a long time, but the RBI has started to ensure that at least public sector banks start to transmit rate decisions quickly. However, even the World Bank in its latest India Development Update report released yesterday said that following 4 policy announcements by the RBI for a total of 190 basis points over the last 4 months, lending rates have only now started increasing by both public and private sector banks. So there's definitely a lag. What does this mean for the public? It means that deposits with banks such as fixed deposits, recurring deposits, etc. are likely to fetch higher returns for customers, while at the same time existing borrowers who have taken loans on a floating rate basis such as home loans will see their EMIs going up further due to the current repo rate hike. New borrowers looking to take loans now, whether fixed rate or floating rate, will also have to pay higher interest rates. Now, for the economy, high inflation and rising deposit rates could lead to a situation where people are content leaving their money in the banks rather than spending on discretionary items like new purchases or on holidays. Companies looking to invest might also decide to defer their borrowing since loans are now more expensive. All of this means that economic growth is likely to slow in the next few quarters, which is the flip side of trying to manage inflation. The RBI confirms this. The governor, in his speech, said that real GDP growth for 2022-23 is projected at 6.8%, with Q3 growth at 4.4% and Q4 at 4.2%. It had earlier predicted that Q3 and Q4 growth would be 4.6%. So, to do a small recap, the RBI has hiked rates, which means that inflation is likely easing, home loans will get more expensive, fixed deposits will get you more interest, but growth is going to suffer somewhat. Looking ahead, as the RBI said, it is still keenly watching inflation. There are several factors that could keep inflation elevated in India, and most have to do with the price of oil. Since India imports about 80% of its oil requirement, the global price has a huge impact on inflation here. The Organization of the Petroleum Exporting Countries, or OPEC as they're called, which are the main oil producers of the world, in October said that they would impose production cuts to keep oil prices up. And last Sunday, they again agreed to continue with these cuts. At the same time, the EU has agreed to impose a $60 a barrel price cap on Russia's oil exports to set a limit on the profits that Russian companies can make. Russia has said that it will not export to countries that agree to this price cap mechanism, so there will likely be some shortage in the market. Now, where there is a shortage, prices are likely to go up. India might not be directly affected by Russia's decision in terms of our oil imports, since we already import from them at a price that's lower than the cap, but every industry uses oil, and so our imports of other commodities might become more expensive. China has said that it's easing COVID restrictions, which means that its demand for oil will likely go up, which will also push the price of oil up. In other words, inflation has not gone, it has just eased. It is still here to stay for at least a while. Expect more rate hikes in the future, but hopefully smaller ones. On that note, thank you for watching.